After Australia officially announced an interest rate cut, the pressure of mortgage repayments began to ease and buyers could borrow more. Finally, we've got some relief. But the challenges remain. Anyone wanting to purchase multiple properties or pay off their mortgage sooner still faces years ahead. Relying on our income to buy homes and pay off mortgage quicker seems like a wish that would never come true. If that sounds like your situation, this video is perfect for you. I'll show you how to transform your primary residence mortgage interest from non-deductible to deductible, dramatically speeding up the process of building your property investment portfolio and paying off your mortgage faster, a method called debt recycling. Hi, I'm Alex. Welcome to O's Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. For most people, buying a primary residence requires a loan. However, the interest on the mortgage cannot be claimed as a tax deduction. This type of loan is referred to as a bad loan. By contrast, investment property loan interest can be deducted from your taxes, so it's considered a good loan. The simplest way to understand debt recycling is to transform the interest on your primary residence loan from non-deductible to deductible, turning bad debt into good debt. Under such an arrangement, you not only gain investment income but also pay less tax because when filing, you now have a new expense item, interest on your primary residence loan. As a result, your net returns becomes higher overall. But how is this done? The principle isn't complicated. It's just that no one has clearly explained it in the simplest terms. According to the Australian Taxation Office, if you borrow money to invest, the borrowing cost is tax deductible. Imagine you have some money in the offset account tied to your primary residence and you want to invest the money. First, pay down the mortgage, increasing your home equity, then immediately borrow that same amount to invest in property or stocks. The interest on this new loan becomes tax deductible because the new loan is used to generate income. You can then use the returns from that property or stock to pay off the original home loan, and then borrow again for investment, repeating the cycle. Over time, your non-deductible primary residence loan balance shrinks while your tax-deductible balance grows. Eventually, your entire home loan can become deductible, and if you only put the investment gains to repay the mortgage, of course you'll pay it off more quickly. Suppose your home is valued at $800,000 with $500,000 loan and $300,000 in equity. You also have $200,000 in your offset account. You could split the mortgage into two parts, loan number 1 with $300,000 and loan number 2 with $200,000. Pay off loan number 2 using your offset money, then immediately reborrow the same amount to invest in property or stocks. This completes the basic form of debt recycling. One key point: leave a minimal balance, for example $1 in loan number 2 so the bank doesn't close that account. If we have $200,000 on hand, there are many ways to use it. Leave it untouched in the offset account, invest directly in stocks or real estate, or complete a debt recycling process before investing. Let's look at how these methods differ in terms of profits. Using our previous example, the primary residence is valued at $800,000 with a $500,000 loan and $300,000 in equity, plus $200,000 in an offset account. We assume a 6% interest rate, a 45% marginal personal tax rate, 4% capital growth and 4% dividends for ETFs, 7% capital growth for property, and a balanced cash flow, meaning rental income and negative gearing aren't considered. If the $200,000 remains in the offset account, you save $12,000 in interest per year, so that method nets $12,000. If you remove the $200,000 from the offset and invest directly in ETFs, you earn $10,600 in 1 year. Returns vary if mortgage rates differ or if ETF performance changes. If you use that same $200,000 for debt recycling and then invest in the same ETFs, you could make $16,000 in the same period. That's because you gain an additional tax deduction on top of the direct ETF investment. Note that loan interest from debt recycling can offset both ETF dividends and capital gains. What if, instead of ETFs, you invest in real estate? Assume you use $200,000 to buy a $500,000 property, factoring in a deposit payment, stamp duty, and so on, while borrowing the remainder. We assume the cash flow is balanced, though in reality, losses might be offset by negative gearing. Under these assumptions, the annual profit is $27,125. With debt recycling's tax savings, that profit rises to $32,525. In this example, investing in property through debt recycling yields the highest returns from $200,000. At this point, you might think debt recycling not only helps you earn more, but also lets you pay off your home loan faster. Truly a powerful strategy. In fact, there are many advantages to debt recycling, including 4 application scenarios, each of which can boost your earnings. Debt recycling offers 4 use cases. Number 1, if you only want to buy a home and don't plan on buying an investment property, you can still apply debt recycling. You might first purchase your home outright, then borrow from your home's equity to invest in stocks or ETFs. This loan is for investment. Its interest can offset dividends and capital gains. Number 2, if you don't own a home yet but have a pile of cash, you can buy a primary residence with full payment, then borrow again to purchase an investment property. This method maximizes debt recycling. If you don't have enough cash, you need a loan for the home purchase, which leads to the next scenario. Number 3, if you already own a home with a mortgage, have some cash in the offset account, and want to buy an investment property, you can first pay down the mortgage with your offset funds, then borrow against the home to purchase the investment property. This makes the interest tax deductible. Number 4, if you only own an investment property with a loan and have cash in an offset account, debt recycling doesn't apply if your next purchase is also an investment property. That's because debt recycling only applies to your home. However, if you plan to buy a home to live in, it's best to use as much cash as possible to buy it and then borrow from that property to buy another investment property. Loan interest is an expense. By using debt recycling, you turn non-deductible home loan interest into a cost that can offset rental income, personal income, and capital gains, effectively reclaiming tax dollars. Saving tax is like earning money. Reinvesting these savings into more properties triggers compounding growth. You can also choose to pay down your home loan faster, an ideal move as you near retirement for better cash flow. Different banks and loan products may have different interest rates, so you need to decide if the benefits of debt recycling outweigh potential higher costs. If you don't have the funds for a home purchase, buying an investment property first might let you benefit from market growth rather than waiting to save for a primary residence and missing out on potential gains. We've talked a lot about debt recycling. Let's sum it up. Debt recycling has 3 advantages. Number 1, tax benefits. Interest on a home loan becomes deductible, lowering your taxable income. Number 2, faster loan repayment. Saving tax is like earning more money, combined with investment returns. These extra funds can help you pay off your mortgage years faster. Well, if that's what you want. For instance, in the early stages of wealth building, expanding your portfolio might be preferable, whereas in later stages, paying off debt becomes a priority. Number 3, diversified investing. Money borrowed from your primary residence can go toward a second property in another state or territory, diversifying risk and optimizing land tax thresholds. While debt recycling has many advantages, it may not fit everyone's goals, and it could carry some risks. Number 1, investment risk. If returns are poor or negative, debt recycling barely helps. Investments must generate income to offset expenses. Real estate has one additional advantage over stocks or ETFs, negative gearing, where losses can reduce personal income tax. Number 2, interest rate risk. If an investment return fails to exceed your mortgage rate, you risk losing money. Number 3, cash flow risk. You must ensure you can repay the loan on time. Either investment must generate enough cash flow or you need a reliable personal income source. Before using debt recycling, there are a few things to check first. Number 1, home equity and offset funds. You need enough equity or cash in your offset to pay down the mortgage and reborrow. If you lack both, you can't apply this strategy. Number 2, money management and self-discipline. Debt recycling is more complex than a typical mortgage. You need to stay on top of bills and maintain good financial habits. Number 3, stable ongoing income. Additional borrowing demands consistent repayment ability. Number 4, seek professional advice. Consult a mortgage broker, an accountant, and a financial planner to perfect your loan structure, tax strategy, and long-term wealth plan. Vision members already have access to these experts. If you're not a member, you'll need to source them yourself. It could take a while to get them to work with each other. If you made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos, and have a good one. Bye.